course, you can now add Korea to the witch's brew of uncertainty facing the global economy. You might ask, how is America's biggest bank managing the challenges there, here, and of course in Europe? Well, you're about to find out. The CEO of JP Morgan's investment bank is here on the inside track. Jess Staley is with us. Jess, good to see you this morning.
Eric, good to see you.
North Korea is clearly the news of the day. I'm curious to know how much the situation in North Korea, we knew that Kim Jong-il would die, fits into the kind of scenario planning that a bank like JP Morgan does. Does it come up, because implications for China, South Korea are relatively big, frankly?
For sure, we all know that the markets are interconnected, and we live in a world today that what happens in Asia is very important to what happens in the U.S. What happens in Europe is very important to what happens in the U.S. North Korea, in and of itself, is not really economically relevant to any of these markets. That being said, the political instability and what it could mean for Japan, for South Korea, which is a very important market for us, or China, for sure we look at those things and we think about those when we run stress tests and scenarios of what may happen. But we've got to see how this plays out, because as an economic matter for the markets purely in itself, North Korea just really isn't on the map.
Well, in economic terms, North Korea may not be a big deal. What's happening in Europe certainly is. Let me ask you this. Every foreign bank doing business in Europe has to make a decision, and many of them have been making this decision. Should I stay? Should I go? What's JP Morgan doing?
We're staying. We have enormously important client relationships across Europe. We've been in Europe for over 100 years. It's a market that we're going to stay engaged in. Actually, you saw from the second quarter to the third quarter, we actually slightly increased our exposure to some of the countries in Europe and in Southern Europe. So we're going to stay committed to the continent. Our clients are there. At the same token, everyone's got to be very conscious that what's going on with sovereign debt in Europe is very troubling, is an enormous challenge for the Eurozone, for the European Union. There are so many issues in Europe that we've got to deal with.
Just why stay committed to Europe? There are people out there who think, and you know this, that it's a crazy idea. There are too many unknowns in Europe. You don't know how the EU leaders are going to act when it comes to interference, for example, doing something along the lines of what they did in Greece, changing the rules of the game, forcing banks to take haircuts. There are other banks, I know because I've spoken to them myself, which think that the prudent decision is to pull back from Europe, to stop engaging with certain counterparties. Why isn't JP Morgan doing that?
Well, we talk about banks being too big. One of the advantages of having the capital strength that we have and the earnings power that this institution has is we can stay committed to Europe and still do it safely. We're not going to put the strength and the quality and the fortress balance sheet of JP Morgan at risk. But because we do have the size we have and the resources that we have, we can stay engaged with our clients in Italy and Spain and across Europe. So we do it with prudence. We do it in a way that's not going to threaten in any shape or form the strength and the resiliency of JP Morgan. But that size lets us stay engaged with our clients, and that's what we're doing.
Jess, it sounds like the attitude JP Morgan is taking to Europe is not unlike the approach that you took during the financial crisis here. JP Morgan did what many people consider to be the right thing, what was good for the U.S. economy, taking over Bear Stearns, taking over Washington Mutual. How can you be certain that doing the right thing in Europe is going to bring the right result long term? Because even though JP Morgan did the right thing here, you aren't always perceived as having been the good guy.
Europe, the whole European Union is an enormous investment of political capital to radically change the landscape in Europe. And it's a very courageous move by the European governments, what they have done and what they are trying to do. And the bank's going to stay engaged in there, and we believe ultimately the Europeans will find a way through this crisis, and the bank will do fine there.
Moments ago, Jess, you were telling us that JP Morgan is sticking around in Europe, not pulling back, continuing to commit capital to its clients there and hoping to weather out the storm. The challenges in Europe among those facing banks. Another thing on the horizon are the Fed's stress tests. Now, I don't think there's anybody out there who thinks JP Morgan is going to have a tough time with the Fed stress tests. But let me ask you this. To what degree do you think these tests are going to restore whatever measure of confidence has still been lost in the American banking system?
You know, any financial market, whether it's residential mortgages, where it's sovereign debt in Europe, financial markets function on the basis of trust and confidence. And we have to have trust and confidence in our counterparties, in our banks, in our governments. For sure, the first stress test done after the financial crisis, I think, did a very important, or played a very important role in reestablishing trust in the U.S. banking system. And so we applaud the efforts to run these stress tests. The challenge is, do they raise, concerns elsewhere?
Well, to your point, right, this one goes a lot further. The last one painted a harsh scenario for the U.S. economy, but didn't contemplate a number of things that are coming around this time, right? The Fed is looking at the situation in Europe and considering a real doomsday scenario. What would happen if European bond yields, or the yields on, say, the Italian 10-year bond or the German 10-year Bund, were to go meaningfully higher than where they are now? Is that a good exercise? Is it right, prudent for the Fed to envision what many people see as, if not reality, a highly probable scenario? Or is it dangerous?
Sovereign debt rests on the notion that a government will do everything in its power to fulfill its obligations, the full faith and credit. Raising the notion that a European government or a government anywhere would actually back away from their debt obligations is something that the market really is not set up to deal with. I thought a very important move by Merkel a couple weeks ago was her comment that asking the banks to take a voluntary default in Greece was not a good thing. Because once you establish that a country in the Eurozone can walk away from its debt obligations, where does that stop? And I think, so that's the challenge we've got. And just like we need people to have trust and confidence in JP Morgan Chase, we need to have trust and confidence in the sovereign debt of Eurozone countries and governments around the world.
But why shouldn't the Fed, or a bank for that matter, look at the situation in Europe and say, what if a country goes bankrupt? Let's remember, and I know you know this because you started in the business when he was still running Citibank. Walter Wriston, the guy who used to be the CEO of Citibank, said once upon a time, countries do not go bankrupt. Well, we found out just a few short years later that countries do, in fact, go bankrupt. It happened in Latin America. We had a banking crisis there. Now we have a banking crisis, an incipient banking crisis in Europe. Why shouldn't you folks at JP Morgan look at Europe and say, it's not a non-zero likelihood that something serious is going to happen? How do we know that Greece isn't going to default?
Well, given that I worked in Brazil during that financial crisis in the 80s, and I saw the utter destruction that the financial crisis laid across the continent, I'm sure everyone is focused on the severity of what's going on, and we have to get this fixed. We as an institution look at all possibilities. We're gonna think about what may happen and what the consequences are, and first and foremost, prepare JP Morgan to weather any storm that comes our way. That being said, everybody, bankers, politicians, regulators, businessmen, we all want to work and join together so that we find stability in Europe. We resolve the sovereign debt crisis in Europe. We get the euro economy growing again because we don't want to walk through that scenario of a sovereign defaulting in Europe.
Nobody does. Nobody does. But at the same time, whether it be bankers, investors, regulators, are beginning to come around to the idea that perhaps we've entered a world in which there is no such thing as a risk-free asset. If that's true, if U.S. Treasuries aren't risk-free, if Japanese government bonds aren't risk-free, if the German Bund isn't risk-free, what does that mean? What does it mean to your business? What does it mean to the financial system? What does it mean to the economy? It seems to be I think a very highly uncertain future.
Well, hopefully one of the lessons out of the 2008 financial crisis is nothing is risk-free. AAA securities are not cash. We've learned that. Sovereign debt isn't without its risk. But it is on a relative basis, where you put on a pecking order that risk. U.S. Treasuries are clearly the safest asset in the world. They will continue to be the safest asset in the world. And a downgrade in and of itself doesn't really change the equation. But everyone has got to recognize that almost any asset on the balance sheet of a financial institution poses some risk, and therefore has to have some capital against it. And we have to manage to preserve the capital strength ultimately irrespective of what scenarios play out.
So how are you looking at treasuries different, say, to the way you looked at them before the downgrade in August?
We don't look at them differently. In fact, treasuries rallied on the downgrade.
Right.
Japan's been downgraded, I think, 2 or 3 times, and we know where their interest rates are trading, and their currency is getting stronger and stronger. So, the market's going to look for what is the safest relative place to put assets, and I think we should move away from saying that anything is without risk. We need to manage our economies prudently. We need to manage our businesses prudently because there is risk behind every corner.
Stephanie and I are going to be talking to you about a couple of things, the outlook for investment banking, compensation, maybe regulation. But first, I know there are a lot of people out there who have listened to me ask you questions about Europe, asked questions about the stress tests, and wondering to themselves, why on earth isn't he asking questions about MF Global? I know that MF Global did business with part of JP Morgan, not your business, right? Treasury and Securities Services, another division. But is there anything you can say about the questions raised about JP Morgan in these congressional hearings with John Corzine?
Obviously, MF Global is an event that hurts the markets and hurts trust and confidence, as we talked about before. JP Morgan is cooperating with all the authorities. I think it's best to leave it to them, and hopefully they uncover what happened, and those responsible are held responsible.
How about Basel III? As investment banks are moving to Basel III requirements in the next few years, how is JP Morgan preparing?
One, let's see how Basel III ultimately unfolds out. The G-SIFI surcharge looks like it's going to happen. As we've talked about publicly, we are very comfortable with the capital that they will require. The bank can easily get to the capital levels of Basel III. People are focused on the liquidity coverage ratio as well. I think what everyone needs to be focused on, however, is we don't want to overly constrict credit. We do want banks to be safer. We want the system to have more, or to people have more confidence in the system. But we don't want to go so far that credit gets pulled from the market and we create an economic downturn because we choke off credit.
Jess, we just showed a graphic for everybody of the revenue that your investment bank has generated year to date through September 30th versus the rest of the street. Here it is, if not the rest of the street, the notable players. You're still ahead. People wonder when we think about regulation, whether it's Basel III or the Volcker Rule, what kind of an impact it's going to have on the bank's ability to generate revenue and ultimately to generate profitability. You and I have been joking over the past few days about the word reasonable and how many times that appears in the Volcker Rule. When it's left up to a regulator to decide what's reasonable in terms of investment banking activity, more importantly, proprietary trading and market making, how do you run your business?
The FT had an article. There have been 14,000 regulatory changes put in front of the bank just in the last 12 months. And as you and I were commenting, in the Volcker Rule, in the current draft, the word reasonable is used 62 times. Imagine if our traffic laws were written that way and we had to drive at a reasonable speed down the New Jersey Turnpike. What does that mean? And I think what it is doing is all this regulatory change has created a level of uncertainty which has impacted the markets and ultimately impacted the economy. The important thing for us is no matter what happens, JP Morgan is going to continue to be a leader in the investment banking space. We have a tremendous client franchise. We work hard on our reputation and doing the right thing for our clients. So there's a lot of uncertainty because of regulatory changes, but we'll be fine.
But even if JP Morgan is, let's say, the strongest among its peers, how do you keep your top talent wanting to stay in the banking side of the business?
Well, we bankers actually take tremendous pride in what we do. At the end of the day, what a banker has to sell is the quality of his or her judgment and the level of integrity that he or she projects to their client. The success of Morgan's not because our chips hold more memory or our cars can drive longer on a gallon of gas. It's what's the quality of our financial judgment. And that's an honorable thing for many of us, and that's why bankers stay working for JP Morgan.
Well, but can you be certain, Jess, that the business that accrues to JP Morgan is coming to JP Morgan because you're offering the best advice and clients can have confidence in your judgment? Or is it because perhaps that JP Morgan has become the safe harbor play in the post-crisis world? That because of JP Morgan's, fortress balance sheet, call it, people perceive it to be a safer institution, a more reliable counterparty. How can you be certain that that business isn't going to go away when the clouds clear, and the sun starts to shine again?
And we're not certain. We clearly have gathered or increased our client franchise because coming out of the crisis of 2008, 2009, we were seen as a safe harbor. What we need to do is to keep our humility and remind ourselves over and over again that that client who came to us because they were concerned about the market, we have to re-earn their trust and their commitment to the bank.
How much of your business do you think comes from that safe harbor play?
It's impossible to say. We have great people. We have 28,000 people in the investment bank dealing with thousands of clients around the world. As long as we stay focused on their interests and what's important for them, we'll be fine.
UBS is calling their private bank really their go-to for their 2012 investment banking strategy, where they will use their private bank relationships to try to win banking mandates. That seems like a very thin plan for a 2012 goal. What is JP Morgan doing in that space?
One, given that I used to work in our private bank, we have a tremendous private bank at JP Morgan as well. And the client franchise does, in fact, lend itself to investment banking as well. But listen, the investment bank, you need to be global. You need to have scale in the financial markets, whether it's rates, whether it's currency, whether it's credit, whether it's commodities. I think size is an advantage in investment banking, and JP Morgan wants to continue to invest in our business throughout the cycle.
You're going to get a lot of resumes today.
Jess, great to see you, and
Thanks,
thank you
Eric.
for coming to the Inside Track. We look forward to having you back soon. Jess Staley, the CEO of JP Morgan's Investment Bank.